And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It's, of course, Thursday. It's the second best day of the week. And don't forget that next week, Brendan and I will be on vacation, so we'll miss you next week. But we will be back the following week, back for our live shows. But all of next week, we will have podcasts for you. So go to our website, realinvestmentadvice.com, click on the resources tab, go to podcast, and you'll have a podcast every day, all through your favorite apps, whether it's Apple iTunes, SoundCloud. They're all there for you. Stitcher, it's all there for you on the website. So we'll have some content for you next week, some of our best of shows that we've done, some of our best of kind of content that we've done. We'll have that for you next week to keep you entertained while we're on vacation. I'm gonna go, like I've told you before, I'm gonna go see my son. Haven't seen him in a couple of years now, so we're gonna go to the UK this next week and go visit him, and then we'll be back the following week. So, as is usually the case, the market crashes while I'm gone. So, in the event something happens, it never fails, right? I will have some posts out next week, some blog posts out next week for you. We'll have a newsletter out next week as well. So we'll keep you apprised of everything as usual. So just make sure you go to the website, realinvestmentadvice.com, and we'll keep you up to date on everything. Interesting news yesterday. New York Democratic Party elected a socialist, a socialist. This guy is like super socialist, and the young people, they were showing the election night kind of party from this, and all the young people of the Democratic Socialist Party were all cheering for less freedom. You know, it's very interesting. This is going to be a very interesting test. Some of the policies that he wants to enact are like government-controlled stores. So, you know, New York is famous for all its bodegas and little corner stores, and, you know, they've been there forever. They're kind of family icons that, you know, for the neighborhoods, everybody kind of goes to these little bodegas and corner shops, etc. And so what the plan is now is to have government-controlled stores and government-controlled pricing on stores, which is going to be a very interesting test, shall we say. I mean, a lot of people from the Democratic side of the aisle have been rooting for socialist policies for quite some time now. And this has really been an evolution that we've seen post the financial crisis. But it's really gained a lot of traction after we started MMT. So, you know, take a step back, you know, prior to 2020, Michael Lebowitz and I were both writing a lot about modern monetary theory and the flaws of modern monetary theory, which is where basically the government provides liquidity to the markets. They see, you know, checks to households, those type of things. And the problem with all this is that it creates inflation, and then it creates a lot of other problems in terms of productivity, et cetera. So Mike and I wrote a lot of articles talking about the problems of MMT, and that was prior to us actually trying it. And we saw the effects of MMT during the pandemic, because we did exactly what modern monetary theory suggests, which is you send checks to households, they go spend it, that creates activity in the economy, but it also creates inflation, and a lot of it. So it's going to be a very interesting, you know, kind of test case here that we didn't learn our lessons about socialistic policies during, you know, coming out of the pandemic. It's going to be very interesting to watch New York City now if he gets elected, right? So it's, you know, this is just, he won the Democratic primary, so he's got to get elected. But if he gets elected, it's going to be a very interesting evolution to watch what happens under his tenure as mayor of New York City. And if he does implement these policies, we'll see socialism in action, and we'll see just how good it is. And it's just, you know, we've seen a lot of the younger kind of millennials and particularly Gen Z kind of rooting for these socialistic policies because the idealism of it is that, oh, everything is great, everybody's equal. That's not the way socialism has worked out in countries, you know, all around the world. In fact, I just saw a very interesting chart just the other day. It showed immigration into countries. And of course, you know, the United States has a lot of immigration from other countries. Europe, in particular, France, Germany, UK have a lot of immigration. You know who has nearly zero immigration? Cuba. Nobody, literally, it's 0.1% of immigration into Cuba. Nobody wants to go to Cuba for a lot of good reasons. Yeah, but you start looking at countries like Venezuela, others, these more socialistic countries, their immigration is very low. People don't immigrate to those countries for a reason. So it's going to be very interesting to watch what happens. But again, this is going to be something coming up. We'll pay attention to it. It's not going to have big major market impacts, but it's going to be a big social experiment. We'll see how it turns out. Okay. We're going to talk about the Fed today with Michael Lebowitz and the mistake that the Fed is making. We'll get all into that this morning. But here's what you need to know before the bell. The rally's on, right? I mean, if you haven't noticed, market's been rallying here over the last 4, 5, 6 weeks, ever since the April lows. And, the bullish sentiment is finally starting to come back. We're finally starting to see investor sentiment turn more extreme bullish. We're not there yet. We're still kind of in the middle of the ranges, but we're starting to finally see the evolution of people going, okay, the whole tariff thing, that's not a thing. The whole debt crisis, that's not a thing. The whole Iran war thing, that's World War III, that's not a thing. And they're starting to look past all these narratives, and we're starting to see that sentiment now turn much more bullish in the markets. And yesterday, the markets knocked on an all-time high in terms of the S&P. The NASDAQ actually hit an all-time high. The S&P was knocking right at it early yesterday morning. Did sell off a little bit in the afternoon. But not surprising. We've had a couple of really strong days here, but we're just pushing on that all-time high. Now, futures this morning are pointing slightly higher. So again, we're going to try to attempt this again. It's very possible we're going to set a high this week, a new all-time high for the S&P 500 this week. Again, you look underneath the surface of this, things are not extremely stretched. Things are overbought in some cases, but not extremely stretched. So there is some room here for this market to continue to push higher, but sentiment is turning much more bullish as we head into the end of the month. Now, July historically, as I've said before, tends to be a much stronger month. There's a lot of reasons for that, but the month of July tends to be a stronger month in terms of the seasonal bias. In fact, it's one of the stronger months of the year. August, September tend to be a lot weaker. So, if there's a risk here of another leg of a correction, which I think is entirely possible, we get another 5% correction sometime this summer. It'll most likely be in August, September, probably not in July. But, again, we'll see how things work out. But again, kind of just paying attention, we've had a short-term MACD kind of momentum sell signal. That's turning back positive, so that should flip back onto a buy today, particularly with the markets kind of pushing higher here. This will be particularly the case since if we hit an all-time high. As we talked about yesterday, the NASDAQ's already triggered a golden cross, and the NASDAQ, the S&P is very close to doing that. So a few more days of advance in the markets, we're going to flip the 50-day back above the 200-day, so that whole death cross will revert back into a golden cross as well. Typically suggests that you're going to get higher prices in the markets kind of in the near-term future. One thing that's been very interesting to watch has been oil prices, because we saw this spike in oil prices because of the whole Iran-Israel conflict when it started. Concerns over the kind of the closure of the Strait of Hormuz. That fell very quickly. So this spike was, basically the bombing when the U.S. bombed the nuclear facilities in Iran. But immediately after that, oil prices have just completely collapsed here. We're back on support down here at the 50-day moving average right now. And we are holding that, but we're on a sell signal. Oil prices are pretty oversold here. So I wouldn't be surprised to see oil bounce here just a little bit. But it's very likely that oil is going to be stuck back down here in the 60s here, at least for a bit, potentially even the low 60s. So again, just from a commodity basis, that's kind of starting to align back. We kind of got past this whole Iran-Israel thing, and now oil is focusing back on economic data, which is showing a lot more sluggishness in the economy. So reduced demand in the economy, reduced demand for oil ultimately, and I think oil prices are really kind of telling us a lot about the economic outlook going into the summer. All right, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk about the Fed's next mistake. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts, of course. It's Thursday. And that means Michael Lebowitz is joining us this morning as well. And going to spend a little bit of time this morning talking about, kind of the Federal Reserve. Kind of all eyes have been focused on the Fed as of late. Interesting article out this morning in the Wall Street Journal. Trump considers naming next Fed chair early in a bid to undermine Jerome Powell. And the candidates currently in consideration right now for to be next Fed chair are Kevin Hassett and Scott Bessent, who is currently the U.S. Treasury Secretary, which would be interesting because you can take the Treasury Secretary, move him over to be head of the Fed, and you have to find somebody to take over as head of Treasury Secretary. So that'll be an interesting move. But those are kind of the three leading candidates, according to the Wall Street Journal right now, for the next head of the Fed. And of course, the idea with Trump is that if I go ahead and name one now, I kind of make Powell a lame duck going into next year because that's when Powell's term ends. But lots of, this is a lot of, political bantering and political positioning right now. And what's kind of interesting and fascinating about this is that the Fed's not political, so we're told. But yet... But yet we have all this going on. Michael, welcome to the show this morning. How are you?
Good morning. Good to be back.
Good. Yeah. You were on vacation last week, so nothing exciting. Didn't get eaten by a shark or anything, so that's always good, right?
And the markets held up. They didn't pull a Lance. So
yeah, I know, right? I'm just hoping I can get through next week, unscathed. We'll see what happens.
Yeah, I'm still trying to figure out why we bought more stocks ahead of you going on vacation.
Well,
we're not obeying our technical rules.
Yeah, exactly. Lance goes on vacation, don't buy anything. So a couple things, Mike, let's talk a little bit about just kind of this headline in the article today that's just hit the Wall Street Journal. Any kind of initial thoughts on that?
I think he just wants another voice the market will kind of think as a Fed voice. Mm-hmm. That'll definitely be dovish, or I would assume would be dovish if Trump is picking him, being that he wants lower rates. But there are also, I think, a few members on the Fed already at the Fed that could become the next Fed chair, because we're starting, whether this is their own opinion or they want their names entered into the race for the next Fed chair. But there's some more dovishness coming out of a few of the Fed speakers. So, I think bottom line is he's going to pick someone to say that rates should be lower. That, kind of what we've been talking about, that employment is starting to slip. It's not a problem, but it's slipping. And inflation may bump up a little bit because of tariffs, but this 6, 7, 8% jump and sustained jump is not showing up. Not to say it won't, but it's not showing up. We don't expect it to show up. So rates should be lower. And I think he just wants a voice constantly peppering the newspapers and the media and social media saying that.
Well, and again, like I said before, it's kind of interesting because, the Fed is supposed to be politically independent, but yet the Fed head is appointed by the president, which has a political bias already instituted in it. Right. So, I mean, if you're put into that position by the president of the United States, you kind of owe some loyalty to the president that puts you there. Right. So it is kind of interesting that despite the fact that everybody says, oh, the Fed's completely politically independent, they have nothing, politics has no effect on them. I think it has more of an effect on them than a lot of people think.
Well, what's even more interesting is typically president picks you, Lance. Mm-hmm. You say, thank you, Mr. President, and you become the Fed chair. Right. If he picks you today to be the Fed chair come, what is it, May?
Yeah.
I think it's May, somewhere.
Yeah, May next year.
Somewhere mid next year. You are beholden to the president for almost a full year before you become Fed chair. So it's a little different this time because he's going to some degree, dictate some of the things that you say, because if you don't say the right things, he'll take it away from you.
Right.
So you come in already kind of voicing his opinions. But yeah, the Fed is political. We've seen it enough. And over the years, it's not just Powell. We've seen it throughout its long history. But it's interesting. It's kind of a new take on what the new Fed chair will bring. And I think as we get closer to that date, the influence of whether he picks someone or kind of betting on who he may pick will start to impact the market, the bond markets, and ultimately the stock market.
Well, again, we know it'll impact the stock market because, every time the market, goes down a little bit, we start seeing, expectations for Fed rate cuts to go up, and the market's just begging for a Fed rate cut just every time that there's volatility. But we've also seen this, kind of just and what's been interesting is we've really seen a change since 2020 with retail investors and their focus on the Federal Reserve. And, they have now been taught that every time the market crashes, that they need to buy it because the Fed's going to step in. And, this we saw in 2022 in particular, the market was declining and we'd have these very big rallies on expectations the Fed was going to stop hiking rates and potentially start cutting rates. And then the Fed would come out and say, no, we're not. And then the market would go down again. But this has been the case over the last several years, is that every time we have a dip, everybody looks at the Fed. What's the Fed going to do? Every time that there's a Fed meeting, all eyes are glued on the Fed presser. Are they going to talk about cutting rates or not? Are they going to talk about reversing QE? It's all about liquidity. It's historically, going back to the 90s and pre-turn of the century, that you could go down the street and ask people who the Fed chairman was and nobody knew. And now they are more popular, I think, than the president in a lot of cases. So, I mean, you ask anybody who's the Fed chairman, Jerome Powell. Yeah, everybody knows it. And that is a change that we've seen really more so since 2008 than anywhere else, because the Fed has been so active in the financial markets during that whole period of time.
And you were just talking about New York City a little bit earlier.
Yeah.
This is financial economic socialism, where the government is just having a bigger and bigger footprint on markets, on the economy, where they're dictating by controlling interest rates, not just Fed funds, but the way that they control Fed funds throughout the yield curve, throughout corporate bond yields, mortgage yields, all those yields. They are continually growing their footprint, and it is a form of socialism, for lack of a better word. And it may give you the results up front that you want, but the long run is reduced economic growth, reduced economic activity, which ultimately translates into less wealth for the citizens.
Well, and again, like in talking about that, you look at socialist economies, right? In general, you have a very wealthy strata, right? The top 1% is very wealthy, and the bottom 99% is basically just getting by on scraps. And that's what most socialist societies look like for the most part. And we see that in the financial markets as well. We've had this big diversification really since 2008. It's got dramatically worse since 2008. Has been this bifurcation in the markets between the top 10% of equity holders and the bottom 90%. So we're just seeing, right. So exactly to your point, we're extracting more wealth from the middle class and shifting it to the upper class through asset price of appreciation, because the bottom 80%, 70% of the economy, they don't do a lot of investing. They don't have the capital to invest heavily into the markets. But the upper wealthy strata does, so they continue to make more money. But it is interesting, Mike, that we're starting to see more and more people now. Equity household ownership is now at an all-time record. We are seeing more households now starting to realize that they have to be in the equity markets if they're going to generate wealth. But they're doing it in a very speculative manner. We just talked a little bit about yesterday on the show that, you take a look at S&P 500 call options, they're at records we have never seen historically in terms of volume. The number of people investing in leveraged ETFs, single stock ETFs, leveraged single stock ETFs, and taking on margin debt is at levels that we have not seen historically. So we're seeing a lot of this retail speculation really ramp up because they're not afraid of a market crash because they know the Fed's going to bail them out.
Well, I think, you're seeing broader speculation in general, right? Sports gambling is taking off like crazy, cryptocurrency. Maybe it's because people are just feeling left behind, and the only way to try to catch back up is speculating. And maybe a lot of people just don't feel they have the option. So,
but the risk of this, though, right? I mean, it's great that you feel like you need to play catch up and you're going to do it through a very speculative manner, but the outcomes of that are not good historically.
Right.
And we're all assuming that we're never going to have another crash again of any sort.
Right. A lot of them just assume NVIDIA is going to 400. And maybe it will, but they don't know anything about NVIDIA. They're not going through their financial statements. They don't know their competition. They don't know what could harm NVIDIA. They're not tracking it the way they should be. They're looking at the price every day. So, that's just one example, but the point is they're generally uninformed and they're just looking at price. And if it goes up, let's buy it. If it was up 50% yesterday, it's going to go up more today. And that's, like you said, very dangerous. And it works until it doesn't work.
So, all right, when we come back, we haven't quite got to our topic yet, which is the Fed's next mistake. We'll talk about that coming back from the break. So hang around. Don't go away.
Life is an illusion. Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife's traveling. She's in Quebec right now for work. She called me up. She goes, everybody speaks French up here. I go, yes, honey. They're a French colony. She goes, I never knew that.
The Real Investment Show podcast. Same show, your schedule.
So the company that she's with took her out to dinner last night. They go to this very nice French restaurant. The appetizer comes out, which is bagua. She goes, that's duck liver, isn't it? Yeah, the rest of the dinner was downhill right from there. So
at realinvestmentadvice.com.
And the only thing that made it better was when they brought the snails out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
One of our chat members this morning is saying that AM 700 is off air right now.
Oh?
So we don't know that because we're on YouTube and X at the moment. But we do stream to AM 700. So if you're trying to listen to the radio show and the transmitter's down for any reason, you may not be able to hear the show this morning. So
Of course, if you're trying to listen on the radio, they didn't just hear
they just didn't hear that. I know, but we do have a member in our chat right now, Silver Bean Counter.
Oh, him.
Yes, and he is saying that AM 700. Well, he's in the YouTube channel telling us that he's also listening to the radio show. So see, there is somebody hearing. I don't know,
and we thank you.
Yeah, we do thank you, and I don't know what's going on with AM 700 this morning. Anyway. So, Michael, talking just a little bit before the break, of course, there's always the political wranglings between the president and the Fed and what's been going on. But, you know, one of the big debates right now, and again, Jerome Powell at his recent meeting, I've got an article coming out on this tomorrow as well, going into a lot more detail of what Mike and I are about to start talking about here, is that the Fed is likely making a mistake here by not cutting rates. They actually probably should be cutting rates. And so, Michael, let me just kind of lay out my premise here really quickly, and then you can just respond however you want. If you agree with me, great. If you don't agree with me, that's fine as well. We'll just have a little debate here. But if you take a look at the economic data, it's clearly slowing down. We saw the employment data just recently. We've had big negative revisions to prior numbers. Employment data came in at 139,000 last jobs report. The one for June that we'll get in just a couple of weeks will probably show that number of 139 revised down maybe closer to 100, something like that. But the trend of employment is clearly slowing. The internals of the employment data is clearly deteriorating. Jobless claims rising, continuing claims are rising. Take a look at the economic hard data, such as ISM manufacturing and services. Those are all at contraction levels or near contraction levels. But so there's plenty of evidence right now that the economy is slowing down, yet Jerome Powell's been pretty adamant at this point that everything's fine. The employment data, the economic data is good. Inflation is at near target of 2%, but it's currently at 2.3. So he's not been wanting to cut rates. However, the problem with that view is, and this goes back to every previous Fed member in history, or Fed president that I can remember, but even going back to Alan Greenspan in 1999, when we were in the middle of the dot-com bubble, he was worried about this inflation boogeyman that was right around the corner and was hiking rates. And of course, we had the dot-com crisis, which eliminated the inflation boogeyman. 2007, Ben Bernanke was worried, was talking about, hey, they're hiking rates. Don't worry about it. Everything's fine. Subprime is contained. It wasn't. 2018, the Fed's hiking rates in September. Hey, everything's great. We're nowhere near the neutral rate. 2 months later, they're at the neutral rate, even though they haven't done anything. And by June of next year, they're starting to cut rates because of the repo crisis. And then, of course, we got into 2020. 2020, they cut rates to zero, started doing $120 billion a month in QE, had a huge surge in GDP, massive recovery of because we were sending checks to households. They kept that stimulus on for way too long. That led to the inflation push. And then here we are today. We're clearly seeing economic data slowing down, and we've got a Fed that's looking in the rearview mirror, worrying about potentially this inflation from tariffs that is yet to show up, yet the underlying economic data is quickly deteriorating underneath their feet. And as usual, my expectation is the Fed's going to be very late to the game here and actually cutting rates and being forced to probably cut rates faster than expected to try to play catch up to what's happening economically. This seems like, Mike, that the Fed's got themselves trapped a bit in this concern over, they'd called inflation transitory previously. They got a lot of flack for calling it transitory, even though it really was. And now that inflation is back down near their target, they're still worried about this resurgence of inflation that's coming. But yet, if you take a look at home prices and what's happening in homeowners equivalent rent, really on a nationwide basis, that all suggests that inflation is going to be a good bit weaker later this year and into 2026. And again, I think that leads them into the position of being late to this game, of starting to cut rates to try to stabilize the weakness in the economy before it really shows up to a larger degree. Your thoughts?
Unfortunately, I have to agree with you.
Why unfortunately?
You're preaching. I don't know. You're preaching to the choir, Lance. About a year ago, over a year ago, I was talking and I said rates are too high. This was when inflation was running in the upper twos. It was clearly coming down. It was trending lower, and we had good expectations that it was going towards their target. Employment market was much stronger. And even then, I was saying rates are too high. Now, they did bring them down, 3/4 of a point or so. But compared to where the economy is growing now, which is probably sub 2%, the natural rate of economic growth is lower than that. Inflation, in my opinion, inflation is already at their target or below if you just replace shelter prices with what's going on, with what's been going on in the real world. Mm-hmm. So you're right. It's the inflation boogeyman that is scaring the Fed, and I just don't understand that view at all. Like, what if, kind of random thought, but what if every retailer decided they're just going to raise the price of everything 5%, or the government puts a 5% tax on everything all at once?
Right.
So it's called a sales tax, right? Prices would go, CPI would go up 5%. Right? Mm-hmm. What can the Fed do about that? Is cutting rates going to do anything? Is raising rates going to do anything? That inflation was due to government legislation. Any inflation because of tariffs, and look, we're not saying there won't be any. We can debate all day how much inflation there's going to be. That's due to government actions. That's not due to supply and demand. Now, it may affect supply and demand, probably negatively. It'll affect demand negatively, which is deflationary. So, they should be thinking about how tariffs impact inflation, but I don't think it should be holding them back from cutting rates, given what we've seen in the employment. The employment market is really slowing down, and we see it not just in the monthly BLS numbers and the ADP monthly numbers. The initial jobless claims, the continuing jobless claims are starting to move higher. They're still at good, healthy levels, but the trends are not friendly. Chris Waller from the Fed, who I think is one of the guys that's trying to position himself for the next Fed chair, if Donald Trump decides to stay in-house, said this the other day: if you're starting to worry about the downside risk to the labor market, move now. Don't wait. Why do you want to wait until we see a crash before we start cutting rates? And I think that's right. Start cutting rates. You don't have to, I'm not saying go 50, 50, 50, 50 and get them down to 2% overnight.
Yeah, of course.
Just tell the market your intent on cutting rates. You're going to do 25 in July, 25 in October, maybe 25 in December, but you're prepared to move faster if the economy slows. Versus, and you can still make comments that if inflation proves to be persistent, that if inflation, there's more inflation, not just because of the tariffs, but because of the reaction, the market reaction to the tariffs, we'll raise rates. There's nothing stopping them from raising rates either. They can go both ways. They could do QE, they could do QT. There's a lot they can do to manage inflation if it does pop up. But there are clear signs that the economy is slowing. And, it's also, we talk about sentiment a lot.
Yep.
Consumer sentiment has improved a little. It's still very poor. And ultimately, consumers are 2/3, 3/4 of the economy. And if they don't feel like spending, you got big problems. And if the Fed can lower rates a little bit and get consumers a little less anxious, more willing to spend money, maybe you can stop the unemployment rate from shooting up and kind of trying to manage it. Again, this is what we talked about in the first segment. This is financial economic socialism, but this is the Fed that we have to deal with, and this is what the Fed does. So if you are going to do it, I think Chris Waller, Michelle Baumann, both of the Fed, and there's probably a few others that are not as vocal, are thinking the same thing. And by the way, both of them think that a July cut is very reasonable.
Right.
So, they're going against Powell. So just going a little bit off topic, but as we look ahead to the July meeting, it's very possible that the Fed does nothing, but there's a few dissenters that wanted to cut rates.
Yeah, it wouldn't be surprising at all, because we are starting to hear some more voices kind of creep up. In fact, today we've got quite a few Fed speakers, so we may actually get some more kind of input on this today from some of the Fed speakers that we have today. But, again, what's interesting is, Powell made the comment that he doesn't mind being late during his last presser. He says, I don't mind being late to cutting rates. He actually does. When you're late cutting rates, you're trying to play catch up to a very weakening economy. And the one thing that's very hard to stop is disinflation or deflation, because it's a psychological process that gets set up within the economy. So it's actually harder to try to stop that process. If you're going to be late to anything, be late on hiking rates, because that's easier to control for the Fed. So it is interesting, he's trying to play this game. It's like, oh, we're being data dependent. I don't mind being late. But, in a lot of ways, it certainly kind of feels like that, even from, if you just take a look at CPI versus Fed funds rates, there's a high correlation between the level of Fed funds and CPI. And if CPI is at 2.3, 2.4, and Fed funds are mid-range at 4.3, Fed funds are clearly too high. They should already have been bringing these down somewhat. To help, and that would help stabilize what is already starting to show up in the housing market. We're starting to see some pretty serious cracks now starting to finally show up in the housing market. Inventory on the market, delinquency rates, foreclosures, those type of things all starting to tick up. So again, the one thing that is hard to stop is if they're late cutting rates and it causes a bigger fracture in the housing market, that's a bigger chunk or bigger problem to deal with. Anyway, we'll come back with Michael Lebowitz and talk about this and wrap it up here on the show this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit about the Fed and, of course, the whole debate over cutting rates or, kind of what's going on. Should they, shouldn't they? And, again, we've got a whole article coming out on this tomorrow that goes into a lot more detail, historically about, the Fed and the problems that they create. And, again, this is the bigger takeaway from all this is that, we're all focused on the Fed and debating on whether or not they should cut rates or should not cut rates. What is clearly evident is that the Fed is always wrong for the most part. And they're either late cutting rates or they're late hiking rates. And this is not something just recently new in the markets. This has been going back all throughout history. And, again, particularly since they've become much more active in the markets, really kind of post-turn of the century, and then really their activity level in the markets have become astronomical since 2008. Again, multiple rounds of QE and all kinds of bailout support and zero interest rates for way too long, et cetera. And, a lot of the problems that we see now, and again, there's some benefits to this. If you're investing in the capital markets and you've had money invested, this has been nirvana for the last 15 years. We've been generating 50% more in the average rate of return than we did over the previous 128 years. So, it's been absolutely fantastic for stock market investors to build wealth. There's no reason for you not to have made money in the market over the last 15 years. All you had to do was just throw stuff into an S&P 500 fund and forget about it, and you're fine. And that's even with 2020 and everything else that's been going on, you've been fine. And that's because the Fed, every time we have some type of contraction in the markets, the Fed steps in, bails it out, markets go higher. And this is why, despite all the concerns, we've had these conversations over the last years about valuations are, extremely elevated. And, this market looks like 1999 and this market looks like, 2007, whatever. But yet the outcomes are ultimately that the bulls return to charge and there's some type of Fed support, monetary accommodation, whatever it is, and markets go higher. And again, everybody keeps, and again, there's lots of reasons to think so, but,
there's a lot of reasons to expect that at some point you're going to have another mean reverting event of some sort, but yet it seems like every time we start a mean reverting event of any type, like 2020, like April, you're down 19%, like 2022 when you're down 20%. And it seems like every time you're going to have a mean reverting event to reset valuations, there's some action by central banks stepping in and starting to bail those out. And again, by the way, while the Fed may not be cutting rates right now, every other central bank in the world is. ECB has cut rates 8 times. The Swiss National Bank is now at 0 interest rates. They're back to NERP. So, this is, a view of a global economy and not just the domestic one that is important to pay attention to because, the Fed may not be doing a rate cut right now, but everybody else is, which means eventually the Fed will be cutting rates again. It's just a function of time. Mike, your thoughts?
It's so funny that, right, the Fed is so worried about everything, but they were so late in late 2020, 2021. They did nothing. They kept rates at 0. They were doing QE like it was going out of style. And at the same time, the supply-demand equation was just getting so imbalanced. And they were just grossly late to raise rates. That was their mistake, was being late. And the result of their mistake of being late was, most likely more inflation than we would have had they raised rates earlier. And it's almost they're making the opposite mistake, but that's what the Fed continually does. They're late, and the results of their actions, whether it's not taking action or whether you're having to raise rates too fast, creates the opposite problem. And this keeps going back to the same problem. The Fed should not be in the business of managing the economy because they don't know what they're doing. They're very smart. They're economists, but they're clearly worried about the wrong things at the wrong times. And I don't have an answer, and I'm not sure you could replace the Fed members with people that would get it just right because the economy is so dynamic. And the more you can leave the economy into the free market hands, you get volatility, but the better off you'll be as far as the wealth of a nation. So, kind of a diatribe about the Fed on and off today, but this is the problem when you have someone driving that train that doesn't know when to slow or when to speed up. And I'm not saying I would know either, or you would know, or the smartest person in the world would know. It's a natural inherent problem with having a managed economy.
Yeah, it's just a quick shift of topic here, just because, but it's very much related to this, is because the Fed's behind this as well. When we go back and look at the Fed's mandates, right, they say that their primary mandates are price stability and full employment. Well, we're at full employment. Great. Price stability, we're at 2.4. Prices are stable. But it's interesting because really what their job is to protect the member banks of the Fed and to make sure that the banks are operating properly and that, there's, plenty of liquidity, et cetera, for banks to operate. And we saw this during the Silicon Valley Bank crisis. We saw the Fed step in, provided, kind of a bailout for the banks there. And we've seen over the years, whether it was the financial crisis or 2020 or a whole variety of other periods, we've seen the Fed repeatedly step in to bail out banks, the financial system, et cetera, because credit is such a massively important part of not only driving the financial markets, but also driving the economy. And I thought it was interesting that there's now this rising kind of push on the Fed to lower or to change, I shouldn't say lower, but to change the capital requirements for the banks to allow them to increase leverage. But yet this was the very thing that got us into trouble in 2008, which was the massive amount of leverage that banks were putting on their books through, kind of the loans they were making, et cetera. And we changed those capital rules coming out of 2008, but now we're going to go back and reverse them again, which is typically what we see right before we do wind up with the next crisis, right?
Right. Bottom line is the banks literally own the Fed. The Fed pays the banks dividends. Now, you're right. After 2008, they put on a special leverage ratio for the most important banks. the ones that were deemed too big to fail. And they have higher capital ratios than the smaller regional banks and the mid-sized banks, meaning that they can basically have to have more equity in every investment, making it less profitable. They can use less leverage. They've been complaining for years. And now I think what's really helping their cause is the Treasury, because they're out there saying, well, if they would reduce our capital ratios, we could buy more treasuries and we could fund massive deficits. And so the Fed has acquiesced. The Fed has lowered their ratios. So the Fed has to, you're what, 15 years removed from the financial crisis, give or take a little.
Yep. And
they're stripping away those same rules that were put in place to stop something like that because of political expedience at the moment. And it's, it's all these traps the Fed gets themselves into that they have trouble getting themselves out of. And it's just time and time again, it goes all the way back pre-19, right before the Depression. We had not a mini depression. We had a stock market crash, I believe it was 27, 28. Fed came in and dumped a ton of money on the market. They lowered rates, fueled speculation like crazy. What we saw in 28, 29 was more so than what we saw in 1999, different companies, but same concepts. And where did we end up with that? 10 years of basically almost 15 years of a depression that we needed a world war to bail us out of. So,
well, and what's very interesting about that is that back then was banks and Wall Street were intricately involved in the 20s, and so after the Depression, we formed the SEC, we broke up the banks and Wall Street, said y'all can't play together because y'all do bad stuff when y'all are together. And then in 1999, not 1999, but in the 90s, we put them back together again because the banks were complaining they couldn't participate and benefit from what was going on Wall Street during the stock market boom. So the government acquiesced, put them back together, and lo and behold, 2007, we blow up again. So, it's, every time that something happens, and we react and create a rule that says, okay, now you can't do that anymore because you were a bad boy. Then we repeal the rule, and then we wonder why we keep getting back up in the same place again. And we keep having the next crisis, right?
Stock buybacks.
Yeah.
That was a post-depression rule that they brought back. They changed because it wasn't some people could make more money if they could buy back their stock. They figured out a way to kind of scam the system. So, again, it's the Fed and it's the government too. They're just as much at fault, both sides, all the time. They're just constantly making rules, taking away rules. They forget what happened in the past. They don't learn their lessons. And here we are again with the Fed. That's like I think it was Chris Waller said. Do we have to wait for the employment market to crash before we try to stop it? And
yeah, we'll find out.
Unfortunately, we'll find out.
Yeah. But again, we've got a lot of economic reports out today. We've got third quarter. That's the third estimate of the first quarter GDP numbers expected not to change today. But a good bit of economic data out there. A lot of Fed speakers. Markets are currently pointing higher here at the open. But again, there's going to be a lot of stuff going on today that could certainly change that very quickly before the open. But right now, the market wants to try to get to new highs. That's its goal right now, is to set a new high. Traders can smell that at the moment, and they want to push this market to new all-time highs. What happens after that, we'll see. But stay tuned, and we'll keep you up to date right here on The Real Investment Show. Get by the website. We've got a new article coming out tomorrow on the Fed mistake, and then the newsletter, of course, this weekend as well. So make sure you're subscribed to the website, realinvestmentadvice.com. Also on Substack at Lance Roberts, and on Twitter at Lance Roberts. It's all there for you. Have a great day. We'll see you back here tomorrow for Financial Fitness Friday.